Let's talk some tech. Kim Forrest is back with us, the founder and chief investment officer at Boca Capital Partners. We've got Tom Whiting here to do some trading on some semis as well. Because Kim, the numbers from the last quarter looked awesome for all these chip makers, but it doesn't look like it's going to be able to hold up, at least right now, in the face of this coronavirus situation. How damaging is this to the outlook we just heard from these companies?
I think for the short term, it's very, very damaging. If nothing else, we're learning all about how China actually works to get products to us, the rest of the world. And Wuhan is in the middle of not only geographically China, but apparently in the supply chain of China. So it's getting affected. It's going to affect these companies greatly. And as a side note, I went to a restaurant supply company yesterday just to pick up something for myself. And of course, I had to ask them, so are there stockouts? Are you getting hit? And they said, absolutely. So even, companies that are far away from technology are being affected by the coronavirus. And I think that's a warning for all of us.
What's interesting is it seemed like the stuff that was far away from technology made the most sense to get hit first. Consumer, travel, these very sort of services type of companies, Starbucks, all that stuff. For tech, walk me through kind of what that means in terms of assuming how the virus then gets down to the supply chain and then the demand side. I know the supply side we can see. For the demand side, what about all the numbers we just got from AMAT? What about the numbers we got from all the chips that said, hey, people are building data centers like crazy?
Right. Well, people still want to do that. But either their timeline's going to have to extend to let supply and demand come in balance for the more commodity chips that they use. But I think really what we're really learning is investors like to think at a high level. And whenever you think of a chip, you think of that completed thing that's in a box. But there's a lot that goes into that, from just the making of the exotic compounds, which China kind of owns that rare earth minerals trade, so that's going to get affected. And that's the very basis of a whole lot of these, especially the more exotic kind of chips that are really in demand for not only things that we can see, like the cars that drive around here testing, the autonomous vehicle programs that are here in Pittsburgh that use these exotic chips, but also for building out 5G, the base stations that kind of get the zeros and ones to our cell phones. So I really think that this is probably going to bleed into more than just a quarter, even if Corona somehow abates in a very short time.
So I think that's an important point, which is if these headlines, let's say tomorrow we get a headline and we see that, or let's say over the next week, right, that the growth rate is not accelerated in the epicenter in Hubei, or there's controlled of the recent outbreaks that we've seen. If that's the scenario, we shouldn't necessarily think the coast is clear as far as the market impact.
Right. It's going to take some time to refill the supply chain. Another thing that we really have to think about is we've probably 20 years ago, all these chip manufacturers went to just-in-time sort of inventory. So they were thinking every their supply chain was a well-oiled machine. And I think this is going to give a lot of companies the space and the reason to rethink supply chain. And maybe they need to have a little bit more on hand if an issue like this comes up.
How come we're not getting updates from these companies yet? If, again, I'll come back to Applied Materials, right? Because I think it's been one of the most compelling tech chip stories in terms of lifting their guidance and really being the first to say confirmed bottom of chips in. I would think that means that they would probably want to get all their materials ready to ship out to the chip makers, all the parts and all the fab stuff. And then if that's then derailed and they see that, how come they're not coming out and saying, guys, our guidance is going to be way off? Because I imagine if that's the case, they're going to be way off.
Right. And well, here's the thing. We're investors. We're interested in this. We probably, the companies who are wanting these chips, probably they can survive. But as investors, we should be watching this carefully for high quality companies that are going to stumble for a couple of quarters. And, these really high prices that they've been trading at, they're going to fall. And I say, sell a little bit of the things that have really worked and have a pile of cash to deploy for these bargains, because the companies aren't bad. It's just a bad situation.
Speaking of the companies, we see clearly, we know stocks like AMD move a lot. We know NVIDIA lately, too, has now become a little bit of a higher beta name within the group. I know you've made the case for Intel and the positives that come with them doing their own fabrication for the most part. Will that help insulate them from supply chain disruption?
For a little while. Again, they know what is in their storehouse, and they can point the customers to products that they know they can complete or they have, which maybe the people who use third-party fabs don't really have that luxury. So they could be more insulated, but especially for the higher-end chips, I'll kind of walk back a little bit. If you're doing it for some sort of specialized application and you've worked with either AMD or NVIDIA, and that is what is going to get deployed on your platform, that's pretty much what you're going to have to do. You can't really quickly sub in and out these other chips if it's a very targeted application like a specific AI engine or stuff like that. But the more commonplace chips, I think there's going to be a mad scramble for an x86 thing that can run in the data center. So that's going to be the wild, wild west here probably in the next quarter.
Yeah, all right. A lot here to process.
Exciting times.
Yeah, right now, definitely under pressure this morning. Kim, appreciate the insight as always, talking some chips here with us. And we got Tom White to do a little trading here. So let's start with kind of a cautionary tone, okay? If you want to kind of balance the positive nature of the last quarter with the negative, temporary, hopeful impact here.
Right.
How would you kind of get that kind of neutral or downward exposure?
Well, Intel, popped after earnings, late last month. Did the opposite of what AMD did. They compete in that business. But I looked in the option market for Intel, probably about a month and a half, nearly 2 months out, April option series. And volatility hasn't exploded in there because it has done pretty well this year, up about 8-9% on the year. And I just looked at a simple put vertical to the downside where I can take a directional bias if I'm a little bit more negative in the near term on these as we get news out of the coronavirus and the effects that it's going to have on the supply chain and demand. But I just went out to the April, buying the 65 puts, which are currently in the money, just slightly, as the stock's below 64.80 at this point, and then selling the 60 puts out against it because I don't want to take too bearish of a tone, and I want to lower my input costs on that. You're roughly paying about $1.50 debit, maybe a little bit more at this point just because the stock's falling as the market's open. But you get that break even down to 63.5. So on a $5 wide put vertical, if this thing goes down to 60 by expiration, it can expand to the $5 width of the vertical. So you're risking $1.50 to make about $3.50 if it goes all the way down to 60. But I think the key takeaway on buying directional verticals, don't buy out of the money directional verticals unless you just want to spend less money.
Right.
Because it's going to take more of a downturn for that thing to expand, right? So when I'm buying verticals such as this, I like to buy that at the money or a slightly in the money strike. Okay. So if Intel does start to drop a little bit, you're immediately going to see that because volatility is going to increase if the stock's going down. So that'll expand the price of the vertical. But then if you're buying the in the money or slightly in the money put, that vertical is going to expand in price rapidly because of that. If you buy something that's out of the money, if you bought the 60 puts and sold the 55s, it's not going to expand in price if Intel drops $1. So that's one of the key takeaways when you're buying verticals. I like to buy that slightly in the money strike on the put side or on the call side if you think it's going to go higher.
Yeah, all right. I like it. Kim Forrest joining us from Boca Capital Partners. Tom White doing the trade here in studio. Nice work here.